In this video, we're going to have a look at the different types of financial documents. Number 1, break-even chart. The break-even point of a company is the point at which they have sold enough products to cover all of their costs and expenses. Usually, a startup business will have the main aim of breaking even. For example, a company must sell 500 items per month at £10 per item to cover all of their costs and expenses, and therefore breaking even. Every item they sell after their 500th item in that month is counted as profit. Remember that this is what a break-even chart looks like. You need to be able to draw one in the exam and label it. You have to plot your fixed costs, which stay the same, your variable costs and revenue on the chart. The point where the black line and the green line cross is where the break-even point is, where you can see the red dot. Cash flow is the money that flows in and out of the business, so your income and your expenditure. The net cash flow is the difference between the money that comes in and goes out. So inflow minus outflow is your net cash flow. Remember that cash flow is different to profit. The cash flow of the business is all about the money that's coming in and out of the business and whether the business has the ability to pay off their expenses. Profit is calculated at the end of the financial year and it indicates where the business is at. So here is an example of a cash flow forecast showing the money which is expected to be paid into and out of the business. So the opening bank balance is what the business starts off with, and the closing is what the business is left with at the end of that financial year. Again, as you can see, there's total receipts, so the money coming in, and the total spending, which is the money going out. So it's really important you know how to work these out. You can also see net cash flow, which is the difference, as we said in the previous slide, the difference between the inflow and the outflow. It's really important also in the exam that you're able to analyse what these figures mean. Financial documents. A break-even chart and a cash flow forecast help the owners or managers of a business plan ahead. It helps financial investors to be able to invest in your business. So it's really important for shareholders. In this way, the owner or manager may be able to put measures in place if any cash flow problems are predicted in the months ahead, for example. So there are 2 financial documents which are prepared after the financial year has ended. However, they are called the income statement and the statement of financial position. So the income statement, the purpose of this is to detail the financial performance of the business over the last financial year. From the brief example below, you can see that the sales are totaled and then the cost of producing those sales is deducted, leaving the gross profit. So you've got your sales revenue minus your cost of sales is your gross profit, and then expenses are then deducted and a final net profit is left over. So your net profit is exactly what you're left over at the end of the financial year. So it's your gross profit minus all other expenses. Your statement of financial position may sometimes still be referred to as a balance sheet, which talks about your assets and liability. The purpose of it is to find out what the business owns and what the business owes, which is the liabilities. The current liabilities are deducted from the total assets, giving the net assets employed, which is what the business is worth at the end of the financial year. This amount is then reduced with the balance with the capital and reserves section. So again, it's important to analyse what these figures mean. So if you have any other questions and want me to go through each of these financial documents in detail, then let me know in the comments below. Thank you.